Hello everyone. Today we will be discussing about tax on sale of property. Property includes three types of property, that is residential house property, commercial property and land, this plain land. So in for computation of tax on sale of property there are three criteria. First is we need to have the sale price, then while executing the transaction there are transfer expenses which are deductible, then the indexed cost of acquisition is deductible, and finally we get the capital gain which is taxable. We have to classify the property into two types, that is long term and short term. So in the case of property, if it is held for less than 24 months or 24 months, then it is a short term capital gain, and if the asset is held for more than 24 months, then it is long term capital asset, which leads to long term capital gains. As far as the tax rates on STCG and LTCG are concerned, then STCG is taxed at slab rates, while LTCG, long-term capital gains, are taxed at 20% with indexation, and this law was in prevailing up to 22nd July 2024. From 23rd July, there is a big change in the indexation method of for calculating long-term capital gains. We'll look at that shortly. So now first let us take a illustration of LTCG computation. Suppose we have a house property which is sold for 1 crore 10 lakhs, and the cost of the same is 40 lakhs and purchased in 2013-14. Now when we index it, the indexed cost of acquisition is 66 lakhs. So in this case, the long-term capital gains will be 44 lakhs and it will be taxable at the rate of 20% plus cess. Okay, so now let us come back to the indexed cost, the law which has changed from 23rd July 2024. So from 23rd July 2024, the indexation has been removed for immovable property. So now, even if it is a long-term capital gain or capital asset, then the tax is levied at flat 12.5% of the capital gains. And this applies to both land or building or both. However, there is a grandfathering option given in case of immovable property, which is as follows. So if a property is acquired before 23rd July 2024 and sold after 23rd July 2024, then the first option with the assessee is to calculate tax at the rate of 20% with indexation. Second option is 12.5% without indexation, and assessee can choose whichever is the lower tax amount. So, but we need to note one thing, that this option is only applicable if the property is purchased before 23rd July 2024. Also, there is one more point covered in the exception which says that this option is available only for resident Indians and not for non-resident. So, if a assessee is a non-resident, then he has to pay 12.5% of tax without indexation on capital gains without indexation. Okay, so now let us take an illustration for this new law. If the purchase in 2015 is for 40 lakhs, sale in 2026 is for 1 CR, then with indexation the LTCG is 35 lakhs. In this case 20% tax will be 7 lakhs, and without indexation there is 1 CR minus 40 lakhs, the capital gain will be 60 lakhs. In this case the capital gain tax will be 12.5%, that is 7.5 lakhs. So in this case the beneficial option is with indexation for the assessee, so he can opt with indexation. Now once we have seen the cost, how to determine the cost, the first second factor important in this computation of capital gains is sale price. So normally the sale price of a property which is to be considered is the sale value, the value at which the property is sold. However, the government has introduced a new section. It is not a, there is a specific section for computation of capital gains on property transactions, which is section 50C. So section 50C is specifically applicable to compute the sale consideration when a property is sold. It simply says that it is applicable when the sale consideration is then less than the stamp duty value of the property. So all types of property have municipal valuation on which stamp duty is calculated. It is also called stamp duty value. So if a seller sells the property which is at a price which is less than the stamp duty value, in that case the government will consider the stamp duty value as the sale value and will ignore the sale value. So even if the sale value is less, the assessee has to calculate capital gains taking stamp duty value as the sale value. And this rule applies to both land or building or both. But there is some relaxation in this section given, which is called as safe harbor rules and reference to valuation officer. So what is safe harbor rules? Safe harbor rule says that if the stamp duty value is less than 110% of the sale price, then the stamp duty value and the difference between sale price will be ignored and the actual sale price will be allowed to be taken as the sale consideration. So if for example the stamp duty value of a property is 1.09 crores and the actual sale price is 1 cr 1 crores, then in that case the assessee can take actual sale price, that is 1 cr, as the sale consideration of the property. Second option given to the assessee when stamp duty value is deemed to be the sale consideration is that the assessee can dispute the stamp duty value. If he disputes the stamp duty value, then the AO can refer the case to the valuation officer, who independently decides the value of the property. So if the valuation officer says that the value of the property is more than the stamp duty value, then his valuation is ignored and stamp duty value is taken as the sale value of the property. However, in case if the valuation officer says that the value of the property is less than the stamp duty value, then in that case assessee is given the advantage and the valuation officer's value given by him will be taken as the sale value and stamp duty value will be ignored. Let us take an example for this. If the sale price is 80 lakhs, stamp duty value is 95 lakhs. Deemed consideration will be 95 lakhs and capital gain will be computed taking 95 lakhs as the sale consideration. Okay, so now we have covered sale price and cost of acquisition. So the computation is sale minus cost minus transfer expenses if any. So once we have reached the capital gain amount, then in case of long-term capital gains, government has introduced some sections which give exemption from tax on long-term capital gains. These sections are, as we saw in the first slide, Section 54, Section 54F, and Section 54 EC. Specifically, let us see what they say about exemption. So Section 54, first it is applicable only to individual and HUF, and it is applicable only on sale of residential house property. Section 54 says that if the capital gain which arises on the sale of residential house property is invested in a new house in India, then the capital gain or the cost of the new house will be exempt from tax on capital gains. So for example, if the capital gain arising is 1 crore and the assessee invests 90 lakhs in a new house, then he has to pay tax on only 10 lakhs, which is not invested by him. However, two things are important. He can invest only in a residential house in India, and he can invest only in one residential house. Only in one exceptional case, very special case, two residential houses are permitted. That special case is if the capital gain is less than 2 crores and this option is exercised only once in a lifetime by the assessee. So once he has exercised his option of two residential house, investment in two residential house, never again he can exercise his option again. So this is section 54. Let us take an example. Capital gain is equal to 42 lakhs. New house purchased is 35 lakhs. Then exemption will be 35 lakhs. So he has to pay tax on 7 lakhs of capital gains. Section 54F. This section has many complicated conditions to attach to it. So in simple words, it is applicable to a sale of any long-term capital asset other than a residential house. So the first difference between section 54F and section 54 is section 54F applies to any long-term capital asset other than residential house, whereas section 54 applies to only a sale of residential house. Second thing in section 54F is also same as section 54, which says investment in one residential house in India. So if an assessee sells any long-term capital asset and invests in a residential house in India, then his capital gains can be exempted from tax. But there are some stringent conditions in section 54F, which we'll see later. The third section is section 54EC. It is a very simple section. It says that if the assessee invests in government bonds specified for the purpose, then the capital gains up to the amount of investment will be tax free. For example, if the capital gain is 42 lakhs, investment in bonds is 30 lakhs, then exemption will be 30 lakhs. One important thing is the maximum investment possible in a year is 50 lakhs. So even if the capital gain amount is 60 lakhs, but he can invest only 50 lakhs in bonds, so the remaining 10 lakhs he has to pay tax. There is a lock-in period for the bonds of around 3 to 5 years. It changes as per the schemes introduced by the government. So in summary, we have seen section 54F, section 54 and 54EC. 54 is residential to residential. Section 54F is any other asset other than residential to residential. And 54EC is bonds. So now let us see section 54F in more details. First of all, it is applicable to individual or HUF. The asset must be a long-term capital asset other than a residential house. So it can be a land, commercial property, shares or securities, gold, etc. Then more stringent conditions are the exemption is available only if the entire net sale consideration is invested in purchase of one residential house or construction of one residential house. Time limit for investment is within 1 year before transfer or within 2 years after the transfer, and time limit for construction is within 3 years from the date of transfer. Second restriction on ownership of house. This is very different from section 54. It says that on the date of transfer, the assessee should not own more than one residential house other than the new house. So if the assessee is owning one house, one residential house on the date of transfer, and if he invests in one new house, then he is eligible for exemption under section 54. But if he is holding already two residential houses in his name, and then he invests in one more residential house, then that new residential house will not be counted as valid investment and the section 54F benefit will not be available. Third restriction is that after claiming exemption, the assessee must not invest in another residential house that is purchased it within 1 year after transfer or construct another residential house within 3 years after transfer. If this condition is violated, the exemption is withdrawn. And the last thing is quantum of exemption. In this case, unlike section 54, the capital gain into the amount invested in new asset divided by the net sale consideration is the amount of exemption given. So for full exemption, entire net sale consideration must be invested in residential house. The other condition which is common with section 54 is capital gain account scheme option is available if the amount is not fully utilized before filing the returns, then the unutilized amount must be deposited in CGAS, otherwise exemption is denied. And lastly, if the asset new asset is sold within 3 years from the date of purchase, then the exemption given earlier will be taxable in the year of sale of the new residential house. So this is all for taxation of sale of property and exemption related to that. Hope you find the video very useful. If you like the video, please like, subscribe and share the video and stay tuned for more such videos. Thank you.